Hi guys, Max here, and this is of course your daily market update for yesterday, which was the last day of the second quarter, the last day of the first half of the year. So we have quite a lot to talk about. But to start us off, what actually happened with markets yesterday? Well, as you can see, equities weren't too happy at all. For the most part, it was red. Big tech in particular didn't do particularly well, with the Nasdaq falling by 1.3% for the day. The S&P 500 fell by 0.9%. Most industries were down, to be honest. There wasn't really much of an outlier except for utilities. The Dow Jones fell by 0.8% and the Russell 2000 did just a touch better at 0.6% losses for the day. Now, as for the rest of the world, well, it was pretty much the same story, except a little bit worse, actually. The FTSE 100 in the UK, for example, fell by 2% for the day. The Stock 600, the rest of mainland Europe, fell by 1.5%. The rest of the Americas wasn't particularly strong, red all across the board, and the same can be said for Asia as well. So really a risk-off kind of day. On the whole then, the MSCI World Index fell by just under 1%. Nothing brilliant, but really in the grand scheme of what we've seen so far this year, actually nothing too awful either. Now, as I mentioned earlier, though, this is now the end of the first half of the year, the second quarter. So how are equities performing for this first half of the year? Well, as you can see, absolutely awfully. This heat map here is of the S&P 500 and its year-to-date performance. Amazon down by 36% along with Tesla. Google down by 24%. Meta down by about 30%. Nvidia down by almost 50%. Microsoft and Apple down by 23%. Financials are down by around 10% on average as well. Consumer defensives are down by 15% for Walmart, 15% for Costco, and then 38% for Target. Real estate's down, industrials are down. The only real industries that are up, to be honest, are healthcare. Aerospace and defensives are doing quite well because, well, the war in Ukraine has sort of pumped a few of those stocks. And then energy as well. If I move myself out of the way here, there you are. There's the energy sector, up by 30 to 40% for most of these energy companies for the year. A really strong year to be invested in energy. As for the rest of the world then, well, it's a very similar story again. Not a strong performance for the most part. Asia has been pretty poor, but China's actually been relatively okay. It already saw massive losses throughout 2021, so there hasn't been as much room to fall for them. Japan really hasn't done well though. Taiwan Semiconductors, being a tech company just like Nvidia, down 32%. Europe, for the most part, is really poor. You see some strong performance there in the UK because actually the UK has outperformed so far this year. But a big part of that is due to the fact that actually, well, the UK has a lot of healthcare and oil companies as well, like Shell up 20%. So really nothing to write home about either. On the whole then, the S&P 500 for this year so far has fallen by 21%, which we'll get onto a little bit more in the future, but that's the worst start to a year since 1970, about 52 years ago. The Nasdaq is down by 30%, and the MSCI World Index is also down by 30% for this year so far. Now back onto what actually happened yesterday alone, the dollar lost just a small amount of its strength and fell by about 0.3%. The pound is back down to $1.21 and the euro back at $1.05, and the yen is still sitting pretty at 136 yen per dollar, so no real changes there in foreign currencies. In the bond market, we did see another flight to safety of inflows into the bond market, people running away from equities. So the yield on the 10-year Treasury fell by 8 basis points and is now just sitting above 3%, 3.01%, I believe, right now. Basically, what we're seeing here is that this flight to safety, people running away from equities, is at the moment stronger than the fears of inflation into the future and the effects of quantitative tightening right now. As for oil prices, well, as I speak, WTI crude fell a little bit more, down to $106 a barrel, and Brent crude fell to $108, sitting just a touch higher as always. Gold also had a small decline and is hovering at around about $1,800 right now. Frankly, I'm quite happy for that. I'm quite happy to start accumulating gold once more at this price point. Now, in general, the talk in the markets right now is all about this first half of the year and how bad it is. But of course, some people and some organizations, the neoliberals around the world like Bloomberg and CNBC, well, quite a lot of them are still putting out delusional articles like this one here. The S&P 500's brutal first half has little bearing on the future, except for the fact that its brutal first half is entirely dependent on the actions of the Fed and inflation. And on that front, we really haven't seen any change so far. Now, as I said earlier, this is the worst start to a year since 1970, 52 years ago, for risk on equities, for risk on assets, for equities, for the stock market in general. So this is really damn bad. And it was made worse yesterday by some new data coming out, which showed that consumer spending had fallen in inflation adjusted terms for the first time per month this year so far. Now, this is something that I've been expecting for a long time now. Consumer confidence has been at rock bottom lows for so long right now, but that's a preceding indicator that precedes people actually going out and spending less. And now we're finally seeing consumer spending, the lagging indicator, catch up and show us the bad data that really, yeah, people are going to be spending less money. And this is usually how a recession starts. We were then lucky enough to be blessed by Michael Burry with a brand new tweet. As you can see here, adjusted for inflation, 2022 first half, the S&P 500 is down by 25 to 26%, and the Nasdaq is down by 34 to 35%, and then Bitcoin is down by almost 65%. That was the multiple compression. Next up, the earnings compression. So we're maybe halfway there. Now, what he's talking about there is actually referring to some previous things he said, where he likened the crash today to the crash in 2008, where at first we saw actually companies and their valuations start to fall without their earnings or their revenues start to fall. But then as the latter half of the market crash kicked in, as the recession started, as people stopped spending all their money on businesses, we then saw revenues and earnings start to fall. And that's really where most of the pain came. That's where things like Bear Stearns and their collapse came about. And so that's what Michael Burry is expecting for this into the future here. He thinks we're about halfway through this crash, which does actually seem fairly reasonable. If you look at historic crashes, they don't happen overnight, as a lot of people like to convince themselves they do. Now, we actually have quite a lot to talk about regarding the crypto market today, which is why I left it until this point in the video. So for the day itself, what did we see happen? Well, we saw more valuations fall across the board. Bitcoin fell a little bit again. It's sitting at about $19,000. Ethereum fell by 6%. It's sitting at about $1,000. And most altcoins were down by a few percent each as well. Really, there's a lot of news that has caused this decline, which we're going to go on into a moment. But first, in the spirit of this being the end of the first half of the year, what happened in the crypto market for year to date so far? Well, as you can see by this deep red here, that's really not been good. Bitcoin down by 60%, Ethereum down by 72%, Binance's coin is down by 60%, ADA is down by almost 50%, XRP is down by 60%. The light red you see here for USDC, well, that's a stable coin, so that doesn't even really count either. The green here that you see from DAI, again, another stable coin. For the most part, the crypto market has been getting absolutely hammered, as we all know. Now, the narrative that's being pushed by the legacy media here is that this is the worst 6-month period, the worst consecutive quarterly period for 10 years for the crypto market. There isn't an awful lot of history to look back on for the crypto market, but considering how aggressive some of the falls have been in 2018 in the past and things like that, this is actually quite major news. If you enjoyed this video, then make sure to like, comment, and subscribe to bless the YouTube algorithm. It really does help. If you want to join our exclusive community, then check out our Patreon. You get access to our Discord server and extra content like access to my portfolio and buy and sell alerts for all my own investments. Also, make sure to check out the link in the description to Masterworks. It can help you protect your portfolio against market turmoil through fractional shares of art from world-famous artists. Art has historically proven to be uncorrelated to the markets, so it's a really valuable resource with the markets falling every week. There's also a link in the description to I Trust Capital, which helps you to invest in crypto through your tax-advantaged IRA, which could literally save you thousands. If you, like me, think crypto going down is a buy-in opportunity, then now is the perfect time to join I Trust Capital. Thank you all for watching. Stay stoic. Until next time.